Grocery is the main driver for this company, but they're seeing in recent weeks some strength for the general merchandise, so they are somewhat positive. Now, what's interesting, we do have the stock higher, although at this point it's up just about 0.2%. One reason could be the shares really priced for perfection. Coming into today, the stock was up on the year by more than 10%. Its closest competitor, Target, down more than 10%. So investors might have wanted a little bit more, even though this was a very clean quarter and a nice guide.
Abby, thanks for that. This headline from Walmart got my attention, that they see headwinds coming from U.S. student loan repayments, even with this so-called 12-month on-ramp, which basically means you don't have to start paying straight away. Target said something similar yesterday. The CFO said the resumption of student loan repayments would, quote, cause additional pressure on already strained consumer budgets. We're going to catch up with Coward on this in about 10 minutes time. Look out for that conversation. Let's stick with retail earnings. Tapestry posting weaker than expected results on softening US demand. The CEO touting its recent acquisition of Capri, saying the following: we're establishing a new powerful global house of luxury brands that reaches across consumer segments. Simone has more. Hey, Simone.
Hey, John. Yeah, the parent of Coach and Kate Spade missing on earnings, missing on revenue estimates for the fiscal fourth quarter. That's ended July 1st. But even worse is potentially the outlook for its next fiscal year ending June 30th, 2024. Seeing adjusted earnings per share of $4.10 to $4.15. The street had been looking for $4.22. Seeing revenue of $6.9 billion. That's up 3-4% from the year, but lower than analysts had anticipated. And even this, going to be driven by international, the much smaller piece of its business, because the U.S. makes up about 60%. And that is going to be up only slightly, according to management. Now, this doesn't include the impact of that deal that was announced last week. It's expected to close next year to buy Capri, but that's going to be a struggle as well. The company's going to have to find a way to reduce its leverage ratio. One bright spot, though, and maybe this is what the market is reacting to here, is that it does see high single-digit growth from Asia and China. That is a large part of its international sales, and a place where there is potential to sell Michael Kors. That is one of those Capri brands.
That stock is up by 0.8%. Simone Foxman there on the story. Let's stick with earnings. Cisco, the shares are moving higher after delivering results that point to resilient demand. The CEO, Chuck Robbins, focusing on the company's AI potential, saying, quote, this is a huge opportunity for the company. We're laser focused on leading and winning in this space. Ed Ludlow, you know the cheat guide if you're a tech firm. Just mention AI.
Yeah. I mean, the story is AI. The shares for Cisco up 3.8% on an intraday basis. That's the biggest jump going back to February. What Cisco said is that they'll be a leader in AI, but they gave tangible evidence that they're already doing that, saying that they booked $500 million in revenue already for their AI-related products. The broader story is that as the hyperscalers move quickly to add more compute for those firms that are working on large language models, they will need the associated data center networking gear, and in Cisco's case, the software that goes with it. Cisco didn't quantify that, though. There's no sort of like, here's the dollar opportunity for us in AI, but they did give evidence that so far they've booked strong sales on it. Remember the other story for Cisco, though, John. They just closed out the fiscal 23 year with 11% year-on-year growth. A lot of that is to do with the component shortages that Cisco experienced through the prior year, and then making up some of that demand that was built up. They were able to get hold of components and sell them. Then it's a different story looking at fiscal 24. We're in the first quarter of their fiscal 24 period, which ends in October. The guidance that we got is that sales will be $57 billion to $58.2 billion in fiscal 24, just shy of the average analyst estimate of $58.3 billion. But if you look at the sell side notes, I think loads of people are quite sanguine about that. 11% growth in the last fiscal year, less than 2% for fiscal 24, but things are normalizing, and something that Chuck Robbins did really sort of effectively is transition Cisco from a kind of legacy tech name that booked sales with big contracts to recurring revenues. Then I go to gross margin on an adjusted basis, 65 to 66% for this current period, above expectations. They're doing well at making money both from the hardware and software components of their business.
I know this is going to be a feature for you guys a little bit later. Look out for Bloomberg Technology with Ed Ludlow and Caroline Hyde. Ed mentioned what was happening on the south side. The stock, by the way, up by close to 3.7%. This is a view from Jefferies. They reiterate their buy after the earnings. They write the following: quarterly results and guidance look solid, particularly in the wake of fears about the organization would meaningfully cut its outlook for 2024. Their commentary about the macro environment was sensible and incrementally positive. That stock is now higher by, let's call it, 4%. Final story for you. Shares of Hawaiian Electric, they remain sharply lower, falling for an 8th consecutive session after the Wall Street Journal reported that the company is speaking with restructuring firms to address their financial and legal challenges due to the wildfires in Maui. Katie Greifeld has the story. Hey, Katie.
Hey, John. Yeah, Hawaiian Electric shares absolutely cratering this morning, currently down about 25% from the bell after, like you said, that Wall Street Journal reporting that the utility company is in talks with restructuring firms to address the multitude of financial and legal challenges that it's facing. For context, of course, Hawaiian Electric supplies power to the bulk of Hawaii's residents, and as a result, it's facing questions over what role its power equipment played in the Maui wildfires. And now, according to the Wall Street Journal, it's in discussion with whether it needs to hire advisors, given that its legal costs are adding up, just as its access to capital becomes more challenged. Remember, of course, on Tuesday, S&P downgraded Hawaiian Electric to junk status. And needless to say, shares have plunged throughout all of this, currently down more than 70% over the past 8 sessions alone. And today looks like we're down another 25%.
That is a tough situation, that's for sure. Katie, thanks for the update. Katie Greifeld there on top of the story. About 7 or 8 minutes into the session, the broader market positive here by 0.25% on the S&P. The Nasdaq just about positive as well by 0.1%, 0.2% higher. iCapital's Anastasia Amoroso expecting stocks to take their cue from 2 key events next week. Unless Nvidia or Jackson Hole save the day next week, there's most likely more downside to go, likely another 3% lower from here. But if we get there, stocks should be a buy, because even though rates are higher, resilient economic growth should offset that. Anastasia Amoroso joins us now. Anastasia, great to catch up with you. Let's start there. Where would be a buy? Where specifically would you look to buy?
Sure, John. Well, the reason I'm looking for about a 3% downdraft from here still is because we now broke through some key moving average levels, the 50-day moving average, and then also the short-term CTA threshold. And if you look at what would be the next sort of reasonable stop for people to step in and potentially buy, it would be a 100-day moving average. And as I mentioned, that's about 3% lower from here. You know, I think that would be a pretty good value given that we've got the S&P that at that point will have corrected by 7 or 8 percentage points. But then I wouldn't just broadly look at the S&P. I would look at some of the semiconductor stocks. I would look at some of the artificial intelligence stocks. And some of them have corrected probably at that point by 15 or 18%. So, you know, given that so many investors probably have wanted to participate this year, but maybe missed that first half rally, I think given anywhere between 10 to 15% pullback on some of those idiosyncratic stories, that would be a great entry point.
What about the rate story, Anastasia? I imagine you get asked that question a lot of times. Can we live with 4% on a 10-year, 440 on a 30-year?
Yeah, I mean, I actually think we can, because if you think about it, John, you know, what's driving the 10-year is a little bit different than what's driving the 2-year. You know, the 2-year, for the most part, it's all about what the Fed is going to do in terms of rate hikes or rate cuts. And if you think about the 10-year, it's, of course, the level of rates, near-term rates, but it's inflation expectations, and it's also growth expectations. And the reason why the 10-year has been rising and the yield curve has kind of been re-steepening is because we've actually got the third quarter GDP that's apparently on pace for 6%. We'll see if that actually sticks around. But either way, the reason why the 10-year rate is moving higher, part of the reason is because growth expectations are also picking up. And if that's the case, then that's a pretty good offset for stocks that, yes, they have to grapple with higher level of interest rates. But if that means higher growth, higher top line growth and earnings growth, that offsets it.
Anastasia, you mentioned 2 themes for next week. One was Nvidia. The second event was Jackson Hole. You mentioned it again there. What would you expect to hear from Chairman Powell next week?
Yeah, I don't really think that we're gonna hear a big change in narrative. I mean, if you look at just the theme for next week's Jackson Hole, it's not sort of the what's happening in the economy right now, but what is happening structurally with the global economies. So I think they're likely to take a look at supply-demand imbalances in labor markets, for example, the fiscal stimulus around the world and what that's done structurally to inflation. But these are not going to be kind of near-term policy decisions of what they may do with rates next month. I think the most important event, for that will be the CPI inflation print that we get on September 13th. And I don't think really Fed Chair Powell is going to talk about that, but the FOMC participants should be looking at the last 3 months worth of data. And if you look at the super core inflation on both services and goods, it's annualizing just about zero, on a last 3 months basis. But again, I don't expect that really to come up, Jackson Hole next week, because I think we need to look for September. But really, that leaves the other huge event for next week, and that is NVIDIA. If NVIDIA does deliver, I think it reinvigorates some of the tech stocks, and if it doesn't, obviously that's a catalyst to watch.
Well, they delivered big time last time around. Anastasia, thanks for the update. Anastasia Amoroso there of iCapital on this equity market. We are about 12 minutes into the session. Equities are doing okay, positive by 0.25%. Coming up, Walmart lifting its outlook for a second straight quarter.
Walmart keeps putting up better margins than expected. They're getting the traffic, they're getting the sales on the top line, and, they really are getting the profitability they need to drop to the bottom line.
We'll be breaking down the results with Cowen's Oliver Chen. That conversation up next.
Walmart keeps putting up better margins than expected. They're getting the traffic, they're getting the sales on the top line, and they really are getting the profitability they need to drop to the bottom line. It just seems that the consumer has been more resilient than I think a lot of us have given credit at this point in the year.
Big time. I think we all agree on that. That was Telsey Advisory's Joe Feldman reacting to Walmart's latest earnings report. The retailer topping Q2 estimates and raising its outlook for a second consecutive quarter. The CFO saying this: "We had another strong quarter. Around the world, our customers and members are prioritizing value and convenience." Bloomberg's John Edwards joins us now to discuss. John, I was talking about this earlier on this morning. If the earnings are good for Walmart, what about everyone else?
Yeah, well, Walmart is taking share from a lot of its competitors, and so it's not, Walmart's success is not necessarily raising other boats, but what we're seeing is, they continue to be in sort of a sweet spot here where they are appealing to the value-conscious, sort of lower and middle income shoppers, but also getting people, from upper income categories who are trading down and finding that they're appreciating the selection and the values at Walmart there. So, it's an interesting situation too, in that, they did raise their outlook, but it's a little bit of a backward-looking raise, if that makes any sense, because they continue to be cautious about the balance of the year. They're saying that the increase in the outlook is basically because they've done so well that they had to increase the numbers for the full year. But they're still making some cautious noises about how consumers are going to hold up in this quarter and the next. So we'll see how that goes.
Flagging student loan repayments as well. I saw the same thing. John Edwards there on the latest. Yeah, John, thank you. The stock is up by 0.7%. Cowen's Oliver Chen weighing in on Walmart's results, saying this: "Walmart was impressive with stronger results in general merchandise relative to prior expectations. Overall health and wellness continues to lead comp sales." He maintains an outperform rating and 180 price target. Oliver, I'm pleased to say, joins us right now. Oliver, how about that? And good morning to you, sir. What do you make of the guidance? And how many headwinds are out there going into the end of the year?
Yeah, we're excited for the beat and raise. It was an all-around good performance from Walmart. What's really working here is grocery as well as everyday low value. The grocery comps were up high single digit. It's been a much tougher situation for Target. As we've mentioned, consumer discretionary at large is under pressure. Target is much more exposed to consumer discretionary, and consumer discretionary trends were a little bit weak at Walmart as well, but we're impressed with what they delivered here this quarter. The consumers are looking for value. They're being choiceful. They do have spending power, but as you mentioned, student loan exposure, it's about 17% based on our survey work at Walmart and 20% at Target. That being said, there is a one-year grace period from which some of the student loans won't damage your credit in terms of the grace period. So that's something to watch as well, John.
Oliver, I was thinking about the same thing. There's a 12-month on-ramp. How do they know? Yeah. This feels like an excuse in the oven for 3Q. Is that what it feels like for you? Just lower the bar a little bit.
Yeah, I think the cautious optimism, they are expecting a decelerating revenue growth in the back half. Our take is that could be very conservative. What we see in the numbers at Walmart is pretty balanced performance from traffic and ticket. Having positive traffic is very good. The comments on back to school at both have been very constructive as well. So as long as Walmart plans for everyday low prices, which they do very, very consistently, that's a key positive. Second point, they're getting higher income consumers. That's a key positive. They're also very focused on convenience. Think about curbside pickup. Think about ordering online. You don't even have to go into the Walmart store to really benefit from this entire ecosystem. The other important point, John, is this digital revolution. So Walmart CEO mentioned artificial intelligence and generative AI. That will play a big role in the future of retail. And we've done a lot of work on computer vision, specifically inventory management and inventory recognition. It's all happening in retail right now.
Oliver, you mentioned the high-income groups trading down. Can we just sit there for a moment? We've seen weakness in luxury in North America. We know there was a luxury watch boom through the pandemic. That's fading pretty quickly. Oliver, what's happening with the high-income groups in America, that high-income consumer?
Yeah, the high-income consumer is seeing cross currents, specifically the aspirational consumer. In terms of that consumer that's shopping for entry-level luxury, that's a little bit weaker. And even though the Tapestry numbers, North America has been tougher. So that is something to watch. Also, John, everybody's traveling, so that's taking share away from tangible goods. On the other hand, we're seeing still solid results from Asia and China in most categories, so that's quite a positive. And at the very high end, that consumer always has a lot of money, so it becomes quite emotional. The very high end remains very strong, and some incredible price raises at Hermes, Brunello Cucinelli, Chanel. That high end is working quite well. So a mixed picture, but overall, luxury goods is a great place to be. As you know, my top stock ideas are Louis Vuitton, as well as Costco and Walmart, thinking about that barbell at the high end and customers looking for extreme value as well. And Costco has a higher income customer too.
That weakness in North America, I saw it in Richemont numbers. I think I saw it from LVMH as well. Oliver, do you think that changes as we loosen up some of the travel rules around group tours from places like China to the US to the UK? Does that change things for the US and North America?
We're hopeful, but regarding China and travel, visa restraints will be a limiter in terms of that. And also, it will be slow and phased in. In terms of the Chinese tourism, John, it will happen most close to China in terms of Japan and Korea. That's happening now, and a little bit later to Europe and the US. But that is a longer-term opportunity. In the near term, we are still cautious on this US consumer, the aspirational consumer. Inflation is distracting to everybody, and that's taking money away from other purchases, as well as consumers going out again. There are bright spots such as beauty, health and wellness. Those have been great categories, and they're very consistent with going out. Thinking about cosmetics and investing in your face is very important.
An LVMH Walmart barbell. Oliver, thank you. I agree. Investing in your face is very important. Thank you. Oliver Chen, thank you very much on the latest. I didn't miss that. 23 minutes into the session. Equity's just about positive with some sector price action. Here's Abby.
Hey, John, it's going to be interesting to see whether or not we have another bearish reversal on the day because we are off the highs, but to your point, a small gain here for the S&P 500. So not surprisingly, more sectors are higher. Energy leading the way, up 1.9%. Materials, communication services also up there. To the downside, though, we're looking at healthcare, consumer discretionary, and tech. As for that energy strength, it really is pretty impressive, up 1.9%. And we have both ExxonMobil and Chevron participating. I believe this sector, John, is higher on the year. I will have to confirm that another time, but it really a comeback for the energy sector.
You can check in a break. Abby, thank you. Your trading diary up next. 26 minutes into the session, we're just about positive on the S&P 500. That's the price action. Here's the trading diary. More earnings coming up later. Deer earnings coming before the opening bell on Friday, plus another read on the consumer with Estee Lauder numbers as well. We round out the week with Eurozone CPI on the data front next week. Just a sneak peek of next week for you. The president heading to Hawaii to assess the damage in Maui. And finally, you'll get the Jackson Hole Summit, the get-together for the Federal Reserve next week as well. Full coverage coming from us, and that first Republican debate in the mix too. So busy week next week. From New York, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
At that all day yesterday.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It is 30 minutes into the U.S. trading day, Thursday, August 17th. Here are the top market stories we're following for you at this hour. 2007 redux for yields. Global yields march to a 15-year high as higher for longer prevails. We're going to see what breaks. So far, not the consumer. Walmart raising its annual profit forecast for the second time as bargain shoppers start to pile in. The stock slightly up on the day. Maybe the yen and yuan. You have reports of intervention lifting the renminbi while traders talk about the yen defense trade. We're going to break it all down for you. From New York, I'm Alex Steele with my co-host in London, Guy Johnson. Welcome to Bloomberg Markets. Guy, okay, you didn't hear it, but Oliver Chen of Cowen, outperform rating on Walmart, was talking about the retail space and kind of what's going to hold up no matter what the consumer does. You know what he said? Invest in your face. Skincare is the key.
I did hear that.
High-end skincare is going to be it. This is all us trying to get Guy to use skincare. That's the trade.
My skincare regime involves sardines. Eat sardines. It's the best future. It's the best way forward, I tell you.
Invest in your face.
Sardines take me to Walmart, which takes me to your question you were posing just a moment ago. I think Walmart is a good news, bad news story. I think it's good news for Walmart, but I think it's bad news for everybody else. I think the signal coming off Walmart is bad news for everybody else. So I think this is a good news is bad news story for everybody else other than Walmart and those people that are shopping at Walmart. Because it's bad for the other retailers. If people are getting sucked into Walmart, that ain't good. Tells you a lot about consumers that are trading down. Tells you a lot of things about what's happening in the economy. And I think it's a good news, bad news story. That would be my take on that one.
Yeah, it just still feels like it's still bifurcated, right? And that's Oliver Chen was talking about. Like you have the high end and then you have the lower end, and those are going to continue to hold up. It does feel like the consumer is going to wind up being in some essence binary. Yeah. And yet
the consumer is totally binary. The consumer is totally binary. You're either a have or you're a have not. And I think that's the story. And it's really interesting looking at the claims data today. How many of those people have got first jobs, second jobs, third jobs? How many people that had second jobs are taking third jobs? How many people are having to spend on credit? I think there's a real divergence emerging, and you're increasingly seeing it in the data.
Which is very different than a higher for longer scenario that we sort of took away from the minutes yesterday that kind of led to the long end spiking in terms of yields, right? A higher for longer is not the consumer is going to fall out of bed.
No, absolutely not, because there's still a big chunk of the consumer that is spending and doing well. And a lot of these inflationary pressures are not going away, which again just kind of beats on the consumer a little bit. But our question is, I think it's a well-posed one, considering what is happening with the curves, sort of the curve shape we've got. You're getting this kind of bear steepening, which is telling you a lot about kind of what the expectation is, and it's definitely that we are going to see higher for longer. We're adapting to it relatively quickly, but what gets hurt by higher for longer? Kelly Greifeld's here to try and answer that question. Sophia Horta-Costa joining us here in London to try and answer that question. Sophia, I'm going to start with you. Is it economies? Is it the consumer? Is it financial assets? If so, which financial assets? What gets hurt by higher for longer, and how far into this process do you think we are?
I mean, Guy, I think I'm going to go with, well, let's go with markets first. You're seeing a sell-off in the thing that everyone had kind of piled into treasuries. You're obviously seeing an unwind of that trade. The kind of recession trade is over. The soft landing, higher for long in trade is starting to really be entrenched. I'm not sure why people are taking this as bad news one day, good news the other, but that's maybe a conversation for another day. I'm here in the UK, and Markets Today, the blog, is very much obsessed with what's happening in the UK housing market. So I'm going to go with the UK housing market, higher for longer, and I do think the BOE has a much more problematic higher for longer narrative than the Fed does. Mm-hmm. Mortgage rates here, they're refinanced in a very short term. Anyone with a 2-year mortgage is going to be panicking about around that. And also, if you need to refinance, if you took a mortgage out 3 years ago, the majority of the market has to refinance pretty soon. So I'm going to go with UK homeowners.
Housing assets.
Yeah. Okay.
Ouch.
See, told you, Guy. So then to that point, though, we've also been waiting for that for a bit. We've also been waiting for the consumer to totally roll over. We've been really waiting for jobless claims to tick higher. So Katie, help me out here. What gets hurt for higher for longer if it hasn't gotten hurt already?
It's a great question. I mean, you could make the case that you're starting to see some of that in the U.S. equity market. You have to square that with the fact that it's August. Trading volume is very light. But you think about what we're seeing in the NASDAQ 100, those growth-oriented tech stocks which theoretically are long duration. The NASDAQ 100 is headed for its third week of losses. We haven't seen that all year, not even in March, of course, when we had the banking turmoil. So you could make the case that you're starting to see risk assets adjust to the idea that long-end rates might have to be structurally higher from here. As Sophia said, we adjust to that soft landing narrative and as the recession trade kind of fizzles out.
Yeah, is what gets hurt in higher for longer the soft landing? To Sophia's point, isn't that what the ultimate casualty here is?
The markets?
No, the soft landing.
Oh, yeah. Well, I would say in terms of the recession trade fading, maybe you are starting to see the soft landing trade actually come in to the market because you think about what's driving higher bond yields. The answer that I've been getting from investors isn't necessarily the idea that inflation is getting entrenched here, but just the idea that the U.S. economy is on pretty good footing here. I mean, you see the economic data coming in consistently higher than expectations. Maybe that's what's driving the revaluation going along long at the long end of the yield curve, and that's what you're seeing risk assets sort of readjust to. Risk assets meaning the equity market. We haven't yet seen the credit market adjust.
Well, here's my question, Guy. If we just take a look at today's action, and I appreciate all the caveats, it's Europe that's getting hit harder on higher yields and not the U.S. And I don't understand why. Why aren't we getting hit harder across the board in the equity market?
I think there's some idiosyncratic stories around Europe. I think Adyen's one of them, and that seems to have taken the stock 600 below the 200-day moving average, which I think Abigail was talking about this earlier on. It has the potential to see this market peak a little bit, and I think maybe you're going to get some of that in light volume during the summer. So there's one factor behind. There's one factor that could have led to that, and Walmart's a pretty big story in the States, and it's a pretty big positive story, you could argue. So maybe it's just as simple as that. I'm not sure I would read too much into that divergence in reality from a macro point of view. I think if both sides of the Atlantic are going to see higher for longer, maybe Europe does suffer more than the United States.
Yeah.
Yeah.
It does make me think
just
of
makes you.
And if that's
Okay,
what we're really
there probably is some positioning there as well. Sophia, your thoughts?
I was actually going to say that word, positioning. I know that's jargon, but let's just think about here. When things are going well, what's the first thing people buy? And even expensive U.S. tech stocks that were just rising and rising and rising, and everyone was saying it was an overvalued market. The moment things start going well, that's exactly what people buy. They're not going to go and search for cheap value stocks in Europe. I do think there's a bias, a very, very big home bias there. I think Europe, the concern here is, well, first of all, that important economies like Germany are actually not doing that well here in Europe, and it's also very exposed to China. Bad news out of China almost every single day. I could go on for years around that story. But also here in the UK, and again, the higher for longer story, I think it's a UK story, not a US story. I think markets will digest that relatively well because the economy is strong. Here we have a much more vulnerable economy, and I think retail sales data tomorrow here in the UK will show that as well.
Yep. So if that's the case, does that mean a better credit market here? Better banks here? Or are we underestimating that risk, Katie?
I will say, in thinking about just what Sophia was saying on the where people go, I just want to add, I was having a conversation with the CIO of a huge asset manager last week, I won't say who, and he was trying to sort of pitch the value of international stocks. And the question is, how hard of a sell of that when the U.S. equity market is off to the races? But to the question about banks, I think it's really interesting to think about what higher for longer means. That means your treasury bills are going to have higher yields for longer as well. Cash is going to remain attractive. And I was just taking a look at money market funds. There's still over $5.5 trillion and growing in money market funds. And you think about the fact that smaller banks are having to pay up for deposits here. That story is still ongoing. That story wasn't wrapped up in April and May. So it's going to be interesting to see how those smaller banks fare, because that higher for longer story really hits them as well.
And that's where you get the consumer problem and auto loans, and that's where it gets particularly exposed in certain small businesses. All right, fun conversation, guys. Sophia Horta Costa and Katie Greifeld. Thanks, guys. I really appreciate it. Still to come, more on our question of the day: what gets hurt by higher for longer? We're going to speak with Nicole Webb of Wealth Enhancement next. This is Bloomberg.
Next week, Bloomberg is live from the annual Jackson Hole Economic Symposium. Our expert team speaks with Fed presidents and other economic leaders as they deliberate the shifting global economy.
What is the response mechanism?
It's not how fast we do it, it's where we go. What are we going toward?
Coverage starts Wednesday, August 23rd with a special edition of Bloomberg Surveillance live from Jackson Hole on Friday, August 25th, starting at 8 a.m. Eastern. Bloomberg, your global business authority.
Yields are probably going to be higher for an extended period of time.
U.S. 10-year yields are on their way up.
Yields have been going up.
High for longer.
Direction of travel for yields, in my judgment, is higher.
This range of, 4 to 4.5.
Up above 4%.
This configuration of a 5% Fed funds rate and a 4% 10-year Treasury, I think it's going to be pretty durable.
Closer to 4.5% before we go down lower.
The tendency will be for higher rates.
390 being the low end.
If you believe that the economy, is entering a soft landing, no landing, whatever landing you want to assign to it, that means rates have to move higher, not lower.
Whether 4% is good enough, I don't think so.
We're very bullish on fixed income as well, but you don't have to take a lot of risk in order to be successful.
We are in a different regime.
Regime that we were in pre-pandemic is gone.
I don't think we found the high end of the range.
It's the tendency for rates to be higher that I think most investors are missing.
4.29, that's where we sit on the 10-year. Some of the top voices we've been speaking with on Bloomberg Television, which brings us to our question of the day. What gets hurt by higher for longer? If 4% is not enough, where do we go from there? Nicole Webb, Wealth Enhancement Group SVP Financial Advisor, joins us now. Nicole, what gets hurt?
The back half of this year is going to be incredibly interesting as we come back into volume after the Labor Day holiday. And when it comes to what gets hurt, our expectation is that we're going to see a lot of pressure on technology companies and the multiple expansion that we've seen year to date, and some of this turnover into more value-centric investing come the second half of the year.
We should probably start, Nicole, good morning by the way, it's Guy, by asking the question, do you think we are heading for higher for longer?
Absolutely. The data just does not support moving away from it. And there's been pockets of reacceleration that are very interesting to us over the summer. So I could make a strong case for manufacturing appearing to have bottomed out, a reacceleration in housing. We start to get curious about inflation when we look later into the year, when we look at shipping costs from Shanghai to Los Angeles over the last 45 days, oil prices up 22% in the last month. This is going to play through, and we don't have a solve for available workers. And so in that too, I think there might continue to be some pressure on wage inflation if we do start to see kind of this, okay, we've dropped off recessionary fears. Where is business headed?
Yeah.
And does that include onboarding? It becomes a bit challenging when you think about it in that regard.
So, Nicole, how do we pair then sort of the read that we're getting from Target and from Walmart, for example, in terms of their outlook? Like, it feels like usually we go layoffs, consumer gets hit, and then banks get hit. It feels like we're not in that cycle this time.
I really don't think so. I think the consumer is just being a bit choosy, and I might have some personal bias here in the way that, myself, our clients at the firm talk about spending habits and change. And, part of the story, I think, for this value trade, or you might hear people talking about the market's going to jog in place, or what we see over the second half is going to happen below the surface. But, there's still opportunity in equities, but your major indices may stay kind of flatlined or in a tight trading range. And that all plays into this story of both the consumer, the inflation story, the multiple expansion in technology. And what it all lends to is inflation isn't technically terrible for earnings for certain pockets of the economy, and the consumer is remaining pretty resilient in the face of a labor market that needs them.
Nicole, higher for longer isn't terrible for certain pockets of the financial sector and the consumer sector as well. If you are debt-free and have cash on the balance sheet, this is a great higher for longer. Sounds pretty good to me. That could be pretty good. And that goes not just for consumers, but it also goes for companies. There are companies out there that finance at relatively low levels. They park that cash. They're now earning on that cash. That's pretty good in terms of cash flow. There are tech companies are an example of this that just throw off cash. There are companies that are able to reduce their working capital. That helps them out as well. Am I looking at companies that have cash and thinking, that's a great place to park my money?
Yes. Yes, and this is the story. This is where when you start throwing around words or picking up on them around it's a stock picker's market, it is to what you are talking about exactly, which is there is an opportunity set for those that have not performed like the index or the major indices really globally, but also in the story I was hearing the two of you speak to earlier, kind of this play on why so U.S.-centric, why trade so differently than the more global markets. And again, when we think about these large-scale companies, we've seen these earnings surprises out of the likes of Walmart, Caterpillar, and Coca-Cola is another example. There are certain companies that are better poised in this environment on a forward look, and also have the ability with some of that stickiness of brand and product to pass along more of these incremental price increases and have it still absorbed without that decrease to volume. And that is what investors should stay in expectation of in the second half.
So Nicole, what else do you like? If you're looking at some of those consumer guys.
Yeah, not necessarily. We don't have any great buys right now in kind of that consumer pocket, but going back to, taking a purview into specific balance sheets as an example, Honeywell is a company that just hasn't really performed as one would expect. They tend to move quite slowly, but they also have zero leverage. And so, they have the sleeper quantum computing arm of their business. So there's names like that, natural gas, liquid natural gas, there's all these pockets of opportunity that play well into the many possible outcomes for the next 6 months.
Do you buy the AI story, and is it kind of the derivative AI story that you should now be looking at?
I play the AI story by believing that there is still the opportunity for a productivity boom in the years ahead. We just did not see productivity, we didn't see productivity in the last 18 months. And I do believe that the investment made and the acceleration of investment made as a result of COVID and the likelihood of the applications of AI across so many facets of business playing really well into productivity. And so while we might not have, nor can we create more available workers, I do believe in the payoff of the applications of these technologies.
And we shouldn't forget skincare. Nicole, great stuff. Lovely. Thank you very much indeed. Really appreciate it.
Invest in your face. Invest in your face.
Seems to be the story of the day. Nicole Webb of Wealth Enhancement Group. Thank you very much indeed. We're going to take you back to tech though, not the face story next. Cisco shares moving higher with results pointing to resilient demand. Eyes, of course, on the company's AI potential. Details of that next. The startup is coming. This is Bloomberg.
It is 22 past 7 on the West Coast. Let's get to the startup where we cover the top tech stories from the Bay Area and beyond. As Silicon Valley starts, it's kind of cloudy, but a little bit blue morning. Bloomberg Technology co-host Ed Ludlow joins us now. Hey, Ed, one of the stocks on the upside here in the U.S. that's also helping the overall index is Cisco. It seems like they could actually deliver some money made from AI versus just talking about it.
That's certainly the story for me. It's a little more sunny down in San Jose with Cisco. You know, they're positioning themselves as one of the main beneficiaries of AI, but you're right that they gave tangible evidence that it's already happening. $500 million of sales directly relating to AI products. Cisco, honestly, like in the realm of technology related to AI, makes kind of the least sexy, least interesting part of it to many, not to me, which is the networking gear and associated software that goes with data centers. So as all of these hyperscalers, think about your cloud providers, AWS, Google Cloud, Microsoft Azure, as they add more compute and they need more data center capacity, they're going to need the networking gear to go with it, and that is where Cisco has been a beneficiary, but they're also really smart at adding a software component with that.
Are they being cautious, therefore, Ed? The guidance isn't exactly kind of blow the doors off.
I knew you'd spot this. It's not. So they just closed out their fiscal 23 year, where year-on-year revenue grew 11%. What they're guiding for this coming year is somewhere in the region of $57 billion in sales. It's slightly below what the average analyst estimate was. But it's partly because of the backward-looking story. So last fiscal year, Cisco started catching up on all of the orders that were impacted by the pandemic period where there were component shortages. Cisco is still a seller of hardware. A lot of that hardware they couldn't ship because of missing parts. Those parts became available, so there was just a big surge in sales growth in fiscal 23. Next year, we're going to go to more like 2% top line growth for the fiscal year, which is not as good. But one way that the market's looking at it is Cisco's kind of stabilizing. Things are becoming less volatile. A big part of that story is the software component we talked about. You know, Cisco's kind of this legacy OG tech name. And what Chuck Robbins has done in his role as CEO is focus on recurring revenues, not just sort of contracts, one-time transactions where you're like, here's your networking gear, have at it. They're better at making money.
What's the OG definition again?
Original gangster. It's probably not the best way to describe a
Oh, I see. I got you.
big tech company.
But to your point, that they were like old school big guy, and then now they're coming back, like sort of what we used to see from like Intel or something, and then they're coming back and they're going to be the big popular guy again, which is quite impressive. So who's like a straight up competitor then from that at that point?
Well, there are loads of suppliers of networking gear. I think, you know, to go back to Guy's question on why this sort of lower growth forecast, the shares are still higher, is that networking gear broadly across this earnings season has seen a big hit to profitability. EPS, bottom line margin. Cisco has adjusted gross margins of 65%, or that's what they're guiding for the current period. So of all of the networking gear providers, it's kind of the biggest, but it's still proving that it can make money in a sort of broader, tough macro environment as well.
Can't believe you said the original gangster. That's kind of maybe the way to go.
I think it's more the point that I didn't know what it meant.
Well, I'm not going to dwell on that.
Like, we can't really blame Ed for answering my question.
Respectfully, old school would have been a better way of putting it, but yes.
Fair enough.
I can understand old school. I could definitely do old school. But Cisco's always been one of those companies that kind of was always at the center of everything, because ultimately it does the connective bit very well and has always managed to kind of find the right niche and the right place to be. It's been through some difficult times, though. It's interesting how kind of cyclical it is and how they're certainly latching on in this new kind of, in this new wave to being right at the center of it. As you say, Ed, the connective tissue is the sexy bit. Honestly.
It is.
Ed Ludlow.
Networking
in
gear.
San Francisco.
Nice.
Networking gear. Ed Ludlow in San Francisco. Bloomberg Technology coming up. Walmart next. This is Bloomberg.
Authority.
We're about an hour into a trading session. Not what I would have thought, considering the move that we're seeing in the long end of the bond market. Stocks kind of going nowhere. Abigail's tracking the moves. Abigail?
They're going nowhere, Alex, but one question could be, will we see a bearish reversal? The S&P 500 at this point slightly higher than one of the big tech indexes, that NYSE Plus Bank Index down about 0.8%. The S&P 500 had been a little bit higher earlier. The 10-year yield, though, it does continue to take the show at 4.3%, and then the VIX is close to a 17 handle. Now, the reason that I'm highlighting the possibility of a bearish reversal, we already have it for the NASDAQ 100. If we take a look at those futures, we are going to see some big decline here. So out of the Asian session, higher, and now at this point down 0.4%. This after the worst two-day slide since May. And August, of course, the worst month of the year. The NASDAQ 100 at this point down more than 6%. I think the S&P 500 down closer to 4%. When we take a look at the S&P 500 technicals, the last time that we looked at this chart, it was probably right around here, making the point that we're probably going to see some consolidation to the uptrend. We're almost there. The bigger question at this point is, will that 200-day moving average come into play? The RSI is close to overbought, Alex, so it's really unclear, but it does seem very clear that we have this 6 to 7% decline in for, actually, this is not the S&P 500, this is the NASDAQ 100, but again, could we see something greater down to that 200-day moving average? That would be closer to a 20% move down.
Fair enough. So, okay, yield definitely affecting some parts of the market. Abigail, thanks a lot. Really appreciate it. So, retail sales, they keep rolling out. You got Walmart lifting its profit outlook for the second straight quarter after a boost from U.S. shoppers. Simone Foxman is watching the move for us. Stock is down now by about 0.9%, but a solid quarter nonetheless.
Yeah, these were great results, but there were also great expectations, and that's maybe what we're seeing in the share price today. If we flip up the boards, we look at what has happened to Walmart shares over the past year. They've been up and up and up until they hit a record high, all-time record high. They closed there at the end of last week. Fifth straight earnings beat. A lot of analysts on the street thought we'd get a beat and a raise here, and that is what we did. One thing that's really interesting to me is what is happening in e-commerce. The company is seeing a 24% jump in e-commerce sales in the United States. The United States accounts for 80% of the business. In the second quarter alone, you can see here what happened during the midst of the pandemic. And now we're seeing kind of a little bit of a comeback there. More weekly active traffic, this seeming to fulfill the promises that the company made when they invested a lot more in their omni-channel, their online offerings, seeing a lot more traffic there. Also, one thing that really struck me as interesting, and maybe something for the broader consumer as well, CFO John David Rainey particularly pointed out private label brands when he was speaking on the earnings call this morning. Walmart has an enormous share of those comparing to other retailers. Mind you, Sam's Club is a Walmart property as well. He says he sees consumers moving to private label brands, eating at home more, and buying more blenders, more mixers, all of those things as well. That could be something we see play out among these other grocery stores and other retailers in the next couple of 10 days, couple of weeks, looking at Kroger next month, but we'll see if they see that as well or if Walmart's taking all their share.
Simone, that's the issue, isn't it? That's the fascinating bit about all of this. Is good news for Walmart, bad news for everybody else. Simone Foxman, thank you very much indeed. Let's carry on the conversation. Cole Smead, Smead Capital Management president, joining us now. He owns Target, he owns Home Depot, doesn't own Walmart. Cole, that seems to be the narrative at the moment. Good news Walmart, bad news everybody else. Is this just the kind of the black hole of US retail? It's sucking everybody in and there's nothing left for anybody else. What do you think of the environment you're looking at?
Well, I don't think about it like that, Guy, because to your colleague's point just a second ago, there's a little bit of a feeling kind of like a post-pandemic. During the pandemic, obviously Walmart and Target gained a lot of benefit from people not being able to really go anywhere else, okay? Walmart has continued to benefit from that because ultimately they haven't been doing stupid things. That's the success of Walmart. Don't do stupid things. In comparison, Target's just been doing stupid things to really hurt their core consumer, which is that, if you're a mother with two kids, you're anything that adds to your plate in a day, you're just going to be less interested in doing business. And they commented on their call that what's gone on in the culture wars is affecting Target. What we think Brian Cornell has missed compared to Target's success right here is he's forgot that the hand that rocks the cradle is the hand that rocks the world. And he's finding that out very quickly. The question is he the right person to run this business? Because if he's not down on his knees praying to God that there's another pandemic, I think he's got a foolish strategy, because so far that's all that's worked in his strategy.
But that's like so much to unpack with that, Cole. I don't even know where to start, like in terms of the different metaphors. But so is it a bet on the consumer, or are you talking about a certain type of consumer and lifestyle? Because those are like different things. The latter will get less hurt if we have a soft landing or a downturn. The former won't.
Totally. So, I mean, Target's core customer is a working mother, more than likely, with 2 kids, okay? But it's a well-to-do woman who is successful, whether in the workplace or in her community. And I point that out because if she's college educated, that's a difference compared to Walmart. Just, it's more likely to be a prime consumer too. So that consumer right now isn't as excited to go do business with Target as you're seeing in Walmart's numbers. And I do think that has come down to what's gone on in these culture battles that Target has decided repeatedly. I mean, if you go back and look, this is not the first time they've done this. They did this with the whole bathroom issue. So again, their team seems to like to go to that line and cross it. Walmart's having no issue like that. We don't understand why the leadership chooses to do this. If you just go look at the demographics of America, 63% of people in America ascribe to be Catholic or Christian. Okay, so that's really like the one standard deviation business in Target's market. Why would you go screw with a 60% of your ball game kind of crowd? We don't understand that. We're not saying that they shouldn't want to serve everybody, but the question is, who's your best customer? That's what most of business is.
Okay, let's talk about the consumer more broadly then, and talk about everybody in the ballpark. What is happening with the U.S. consumer right now? It feels increasingly to me, looking at the data, Cole, that this is a have-not economy, and that divergence is only getting better. I look at the credit card data, I look at some of the survey data, look at the Fed survey data. Seems to be telling me that there is a significant portion of the U.S. consumer base that is increasingly struggling. It's got 1 job, 2 jobs, 3 jobs, that portion of the consumer base. What do you think is happening here, and who is best positioned to deal with that divergence?
Put against that data you just said, go look at the wage data. If you look at the lowest quartile of income in America, it continues to stomp every other quartile, with the third quartile doing just about as well. So the bottom half of incomes in America are outpunching inflation. They're outpunching white-collar workers. Mm-hmm. It's really tough to have a bad economy when low wages like this are doing so well. So I think that you're the Fed. You're sitting back going, gosh, we didn't break housing. Gosh, we didn't break the labor market. But what they've broken is certain parts of the capital markets. I mean, there's an article you guys had out yesterday talking about 15-year mortgage supply drying up. Yeah. In other words, everything tied to capital markets is having issue. But the excess savings and the strength of low-end wages in the U.S. economy and housing is the unstoppable force that the Fed and really economists have trouble with today.
Okay, so this is such a good point, Cole, because there was a Fed paper that talked about that excess savings. Not everyone seems to agree on like how much excess savings there is. So let me just pull up the chart for you, and it shows sort of the rise of pre-pandemic, during the pandemic, of that savings. That's that green stuff, and then the red stuff is how it's being drawn down. And correct. There seems to be not that much left, according to this paper from the Fed. How do you see that evolving? And then does eventually like the capital issue and tightness then flow into the consumer that you were talking about?
Well, again, who can deal with this the longest is the wealthiest people, because they had, a disproportionate part of the excess savings. Now, here's what's interesting about them. We go out of the pandemic, you see lower incomes really splurging on TVs, luxury items, etc. But what's going on in travel right now? That's not lower end wages. They're working. What's going on is that's wealthy people who are still going out and gallivanting and having fun. I think those wealthy people will continue to spend because stocks and bonds aren't producing them the returns they like. And dogs chase cars, people chase stocks, and they're going to chase whatever they feel good about. Housing so far has proven to be a better thing to chase, but you can only have so many residences, and that's tough institutionally over time. So we look at this as,
in some ways, if you don't carry a lot of debt, you got a lot of cash, you're getting paid right now. Even if you just park it in a money market fund. Just a final quick question, Cole. Yeah. It was raised on the Target call. It was raised on the Walmart call. They're worried about the return of student loans. Now, how that happens and when that kicks in, I think is up for debate. But they're all mentioning the fact that they think the student loan resumption story is going to hit them. Do you agree? And when do you see it happening?
so far in my career, Guy, the biggest myth that has never proven to cause the issues that people thought has always been student loans, right? Millennials were never going to buy houses, Guy, because of those student loans. That just ended up proving to be a myth, too. So the student loan is a great political palette. It's a terrible way to go out and invest, in my opinion.
No, fair enough. And you have to wonder then if it's just sort of like tampering down expectations when retailers talk about it rather than talk about the overall
I agree.
economy
It's a good
or their
excuse.
management. Right.
It's a good excuse.
It's not weather, it's student loans. Hey, Cole, we got to leave it there, but it's always good to catch up with you. Thanks a lot. Cole Smead, Smead Capital Management President, thank you so very much. Well, coming up, let's stay on the consumer because jobless claims fell the most in 5 weeks, showing signs of a continued labor market resiliency. How long does it last? What's the feed through? We're going to break that down next. This is Bloomberg. U.S. weekly jobless claims fell by the most in 5 weeks as the labor market continues to show resiliency. Now, we were just hearing from Cole Smead, who's really sort of betting on that lower-end consumer because that's where the wage growth is. So we wanted to take a look at the jobs market in more detail. Julia Pollack is chief economist over at ZipRecruiter. Is your jobs data showing the same thing as wages seem to, and how we were just talking about that lower-end consumer really driving consumer growth?
Absolutely. I mean, during the pandemic, that low-wage worker got large unemployment benefits that often exceeded their prior earnings and stimulus checks that allowed them to improve their credit scores, pay down debt, and qualify for additional goods and loans. And now some of those workers who are seeing wages grow but are also seeing inflation